And then let's deconstruct fractional reserve banking real quick too, because this is another thing that's proliferated by the Creature from Jekyll Island, and this is I think also where a large misunderstanding of the interest rate comes in, which is to say, okay, um, the way banks work is they open up a bank, and then once they get a certain amount of deposits, they're able to loan out a multiple number of that deposit. Let's say so they got $100 deposited, they can loan out 10 times that amount of money, as long as they keep that deposit there. So that means they can loan out $900 because they got to keep 10% on the books, and so that allows $900 of money creation. However, the problem is when they've lent that out, so they've lent out $900, and let's say the person owes back $1,000 because it's $900 principal and $100 interest, whatever that interest rate works out to be over the term of the loan, right? Now, in a the aggregate system that we're theoretically creating here, there's actually more money owed to the bank than there is money in existence, right? Because $900 has been created, but $1,000 is owed back. And so the way that the economy deals with this is that somebody else gets a loan and says, okay, I loan, I borrowed $900, I owe $1,000 back, and I paid the first guy, he could pay off his first loan, but now the second guy has this running interest debt that can't be paid off by the entire economy because of this fractional reserve system, where there's this limit on how much money that can be created based on the reserve rate or the reserve requirement, right? Nima was one, most of the stuff, who pointed out to me that's absolutely backwards of what actually happens. Is that if there is a reserve requirement at all, and some countries have no reserve requirement, like Canada, for example. If there is no reserve even if there is a reserve requirement at all, what creates the money has nothing to do with the deposits that are sitting in the bank. What creates the money is the bank going check and creating the money. And what speeds them up or slows them down are the number of ready, or how do you put it, willing and able borrowers.
Yep.
Right? So Nima's the bank. I got a business idea. I come to Nima and I say, look, here's my business idea that's going to create this much cash flow. I need $100,000. And Nima does his underwriting and go, well, this is a pretty good risk. He should be able to pay this back. Or they go, no, this is too risky. We're not going to do it. If they say too risky, the money doesn't get created. If they say, we think you're good with that. Now the money gets created. Nima gets the $100,000 to go run his business with. Then after that, they go, okay, what's the damn reserve requirement? Okay, at the end of the week, make sure that we get that much reserves in the bank.
Right.
And what's important on top of that is that the reserves are literally always available. Either on the interbank lending market, because the banks lend each other these reserves all the time, or in the last resort, the lender of last resort, the Federal Reserve, every bank has a line of credit at the Federal Reserve where they can get the reserves if they need to.
Yeah, it's actually just works as an overdraft.
Right. So
you don't do anything. The system still functions. You just incur an overdraft at a certain interest rate, which is higher than what you could get from savers or interbank lending.
Right. So there's this idea that this fractional reserve lending system has inbuilt into it an eventual crash, because as this money is getting created, more interest owed is being created than principal in existence. So at some point, the hot potato just keeps getting tossed until somebody holds it, and then the private sector can't finance its own debt it's created, and then everything implodes, and it's limited by, okay, how many deposits are there in the first place?
Mm-hmm.
That's just entirely not even remotely the case, not even close. So, and I think the Creature from Jekyll Island is largely responsible for promoting this fractional reserve idea that just isn't accurate at all.
Right. It's as with so many things, it's backwards. The banks create the money, so the banks don't wait. Just if you think about it logically, the banks and government create the money. So the banks and government don't need your money to be able to make a loan. They make a loan if they find a willing and able borrower and he's worth the risk. They will make the loan out of nowhere, out of nothing, and they will mark up the checking account, and if that person, once that person uses the money, makes payments, obviously now he writes a check to another bank, then that other bank is going to demand the reserves from the initial bank, and now the initial bank needs to attract reserves. They can do that by borrowing from the Fed or from the interbank, or by attracting
Depositors. Yeah.
savings deposits to, and usually the savings deposits are a lower interest rates than what they can get from the interbank market or from the treasury. And checking accounts, by the way, are the best kind of money to attract because they don't pay any interest on that. Now, just one minor clarification: you said the reserves are always available. There can be situations where the banks get in trouble, as we've learned, as a result of this constant adjusting of this interest rate
Right, well,
dial.
okay, I'm sorry about that. As a result of somebody playing with the dials at the Federal
Right.
Reserve, not knowing what they're doing.
Right. So,
Yes.
so, so in 2022, the Fed embarked on a really aggressive interest rate hiking spree, which was so unprecedented. It was rapid. It was I don't want to say unprecedented, but unexpected. Certainly, it came out of nowhere, and the whole system. This is part of the problem. The system adjusts around a given rate, just as the system adjusts around what a meter is, or what a yard is, or what a cup is, or what a foot is, right? Imagine the Fed came out and was in charge of these
Yeah.
numbers and
A meter
constantly
is now this
adjusting.
long instead of this
Like,
long. Yeah.
it's like
Right.
all the civil engineers like, oh shit, now we have
Yeah.
to change our blueprints there. So that's kind of like what they're doing with the financial sector by constantly adjusting the rate. But yeah, they could just keep it at one level. But in the case of Silicon Valley Bank, there was indeed this phenomenon where the banks have leeway in their reserve account, right? The money where that comes in from deposits, they can keep it in reserves at their local Federal Reserve bank, or they can a regional Federal Reserve bank, or they can buy treasury securities with treasury bonds, treasury bills. And what they started doing, because interest rates were so low post COVID, right? Because they cut them all to zero. They were higher, then they
Mhm.
cut them to zero. Okay, rates are so low. We want to generate some more income on our reserves. So we buy some treasury bonds that were at the time paying maybe 1%, maybe 1.5%, and they were relying on that sort of configuration for their loan to assets to liabilities
Right.
portfolio.
And then really important, just as a to insert there, their assets to liabilities requirements are entirely arbitrary legal requirements. It's not because this is how reality works. It's just because these are the rules that the government said that they have to follow, and they're
No,
totally arbitrary. Wanted to throw that in there.
no, no,
Yeah.
no, that's not what I was talking about, though. So
Oh, okay. Sorry.
the asset liability requirements that I was talking about are not arbitrary at all. They determine whether or not the bank is profitable, because
Oh, I
the
see. Yeah.
the interest paid on their assets minus the interest they have to pay on their liabilities is the bank's profit. So this was not an arbitrary situation. This was the bank's profitability depended on an asset to liabilities match that provided this level of revenue and this level of cost, and so some profitability. But what happened as a result of this rapid interest rate hike was that the value of the treasury bonds in the reserve account started plummeting, and in parallel, simultaneously to that, there was some psyop that was initiated by people like Peter Thiel and other VCs. I don't know if it was a deliberate psyop or one born out of economic ignorance, but people started saying, "Oh, this bank looks shaky." But I don't know why. The bank didn't have bad loans on its portfolio. The bank didn't have a bad quarter or whatever. But or maybe I don't know. Maybe they had the missed expectations to some extent. But the bank did have the problem at this point where now all the big money from all the companies, the VCs, which a lot of startups were using this bank for their daily banking. Now all these depositors start pulling out their money. So a lot of checking account money started leaving the bank,
They're
going
cheap
to
reserves.
right the
Right.
cheapest possible reserves. Now, in order to be able to meet clearing demands, right, people writing checks to other banks, and maybe also the reserve requirement, they had to sell some of these treasury bonds and sell them at not insignificant losses. So these losses would then show up on their balance sheet, and the question, and then at the same time, the reserves that they were able to obtain that were non-checking account reserves but savings deposits were so costly because the rates at this time were yanked up to 5.5% or so, and the loans on the interest on the loans that these banks had made in the 2020s, 2021s, etc., some of these mortgage loans were paying something like 2.5, 2.8, 3% maybe. So there was really no viable model for this bank to continue with these expensive funding sources. And this was mostly just because all this checking money was sucked out because of the panic.
At the
And
same time that the rates got drawn up right after they
right,
had invested all this money in low rate treasury bonds, right?
exactly, the losses that had to be booked then when the treasury securities were sold. So then they got subsumed by larger entities, and a lot of these deposits went over to J.P. Morgan. I think. Actually, in the case of First Republic, I believe they got taken over by J.P. Morgan and
There were
Silicon Valley.
sharks coming after those really good loans that they
Right,
had.
because the loan
No, there was
portfolio was
anecdotal, but there was a bank. Actually, I won't say it. There was a bank that was trying to get my business deposits, and they were whining and dining me, and we got on this. This was right after the Silicon Valley bank fiasco happened, and he said, "Oh yeah, we ended up with a lot of those assets from the Silicon Valley Bank." And I mean, I'm not criticizing him, but what his bank was like, "Oh yeah, we got a ton of good assets from the Silicon Valley Bank." The point I'm trying to make is, it's not like they had bad assets, right? And
yeah,
then when we did that show, I also remember that you were able to show that Silicon Valley Bank was actually making a really good effort to get its books
yeah.
right. And it looked like he was on the verge of getting there when the whatever Department of Finance director, somebody or other from the state of California, just unilaterally declared this bank is insolvent. It's done.
Right. Even
Yeah,
though it didn't seem like there was a failure to pay, there was no creditor came and said, "I didn't get my money," as far as I
yeah,
know. Now, it could be that maybe it due to this whole fiasco that the Fed had created before with the volatile interest policy, that maybe there was that created the problem for the bank
right.
potentially. I don't know, but then guess what? After these two banks were taken over by the big guys, by J.P. Morgans of the world, the Fed introduced a policy where, oh, all these treasury bonds that you have that have lower value now, you can actually just tender them in with us, and we will give you the equivalent amount of reserves in as face value at face value of the treasury bonds. So problem solved, right?
It would have saved them, but
Right.
they did it
They
five
could have
minutes
done
after they
that
got closed
before.
down. Yeah,
And so yeah, this whole thing, it's unfortunately too much ignorance about this whole topic to where such a simple solution could have just, I guess it's just too many people yelling and screaming off the top of their lungs that you can't just push a button to solve this problem. But this solved the problem. There was no other banks, really, no other major high-profile bankruptcies or insolvencies of any such banks since then. So that was yeah, going back to the Fed topic, but yeah, that is something we criticize about the Fed, the fact that they try to manage the interest rate, the risk-free interest rate, which is unnecessary, right? And number two, the fact that they did it, for example, in this case, they did it so in such a volatile fashion and in such brutal fashion that just it was designed to catch everyone off guard. They thought that they were doing something smart. They thought that, oh, this all this inflation, that's we're gonna nip it in the bud and stop it by doing something so radical. It's like you have a headache, and so you give
chop your head
someone
off. Yeah.
Yeah, chop your head off to cure the headache kind of solution. Very crude, very dumb, very ineffective. And like I said, a year we told people inflation is not going to go down from hiking interest rates. In fact, inflation to start it kept on going up, but it's going to level out as oil prices level out, because that was the biggest driver of the 2022 inflation. Obviously, was the war in Ukraine, the oil price shock, and obviously then other factors were the
Well,
stupid
there was the COVID shock,
the
right?
COVID.
That we're
Yeah,
still supposedly halfway in, and a big one is the labor shock that we're having because there's more boomers exiting the labor force than there are Zoomers coming into it.
yeah. Yeah, but so there's the multiple effects, right? There was this, okay,
Yeah.
you got to stop working, you got to shelter in place, you got to stop consuming all these things that you used to consume, can't go to the gym anymore, blah, blah, blah. And so a certain degree of the country's productive capacity was just shut down voluntarily. People just decided, okay, let's shut ourselves down to cure the killer coof that's going around, obviously, right? Because that's how you cure a medical issue. You shut down your economy, and then so you reduce supply, at the same time you just loaded up the money bazooka on like anything we've ever seen on the global scale. There was never so much deficit spending at one time, I believe, as there was during 2020. Now, maybe in the US we had World War II, the figures were kind of proportionate to back then, but I don't think on the global scale there was ever such a coordinated, concerted injection of deficit money into the economy, while at the same time shutting down your productive economy. Okay, so you're reducing your supply, you're increasing your demand, and you prices will go up, and then on top of that you muck up the supply chain, more reduction of supply,
And throw a
then
bunch of money into it on top of it. Yes.
right, and then you launch all these sanctions because you disagree with some country that's far away, that's dealing with a border issue that's none of your business. And so all these things, and it's actually quite amazing how low inflation has been throughout all of this. It could have been much worse. But the US economy is very diverse, very resilient, very large, so it can absorb these shocks over and over. But these were sort of the reasons why we saw this inflation. And whenever the root cause of the inflation began to level out, you would expect inflation to also level out, of course. So that has happened, and now the inflation is coming down. And now, as they usually do, they start reducing the rates as they see that inflation is coming down. um
They're
not
reactive, not
Yeah, they're
proactive.
reacting, not being proactive about any of this.